Welcome everybody that is here today. Thank you for joining us. I'm Dee Childers with Life Changes Elder Care Consulting and Vice President of Learn and Community Education Chair. And I am so happy to introduce today Don Levin from PNW Insurance Services. And he's going to talk to us about long-term care insurance and helping us understand what that looks like in today's world. And because I have lots of questions about how things have changed and what we need to be looking at as options out there for that. And I first would like to just take a second to talk a little bit about what Learn is. So Learn is Lifelong Education and Aging Resource Network. We are an Idaho-based nonprofit organization with the mission to provide quality community education on retirement and age-related topics in the area of health, wealth, lifestyle, and caregiving. And Learn is a leaders network of the Society of Certified Senior Advisors, CSAs. And so we're part of that organization and gives us big visibility and lots of resources. Everything today, I'm sure will be top-notch information, but because we are a nonprofit, our disclaimer is that the content for information today is for general information purposes and is not to be considered legal, financial, or health advice. Be sure you consult with your legal, financial, or healthcare or other service providers before taking action based on this information. Today's presentation is sponsored by Life Changes Elder Care Consulting. Happens to be me. I believe so strongly in what we're doing that I wanted to make an investment into our rollout. We attempted to roll out last year before the pandemic and was not able to make that happen at that point in time. I keep forgetting what screen I'm looking at. And so we kicked off again the beginning of this year, and I'm very proud of this organization and what we've been able to accomplish. And we have an incredible president, Dara Ray, and incredible members, all professionals. And Don is one of those professionals that has joined us from early on. He is a managing general agent for PNW Insurance Services and is going to take us through today and talk to us about understanding long-term care insurance. And so, Dawn, I am going to hand it over to you to share.
Please do.
Figure that out.
Just make me a host and allow me to be a panelist, and I can.
I know, I swear, every time I do this, I do it and then it doesn't work. So there we go. Okay, you should be able to share now.
Okay. Let's see.
Well, I think you're sharing again, Dee.
I think I am. Okay.
You should be able to share now, Don. Maybe.
Let's try it again. There we are.
Yay.
Hope we can just get the full screen. Come on. There we go.
Yay.
Well, thank you for taking the time to dial in today. And you got me and you got me. So Come on. How about that? Let's go with that.
Very nice.
Okay, so I'm flying under false colors. Here in Boise, I am P&W Insurance Services, but nationally, we are USA LTC. It's interchangeable. I'm the same guy. We just have a lot more people on a national basis. So, but this is who I am. And the thing I'm most proud of are the last 2 bullet points, the 5 kids, the 19 grandkids, the 1 great grandkid, and I'm a long-term care policy holder. And as the industry has changed a great deal over the last 10 to 15 years, that has been a source of great peace of mind to myself, my wife, and to our children. Because if you've ever been a caregiver, you know the challenges associated with that role. And years ago, I had all 5 of my kids together. We were at my son's clubhouse. We were at the pool, and I walked out with my bottle of suntan lotion, and I was really excited. I felt like George Bailey. I was the richest man in town. And I said, who's going to help me out with some suntan lotion? Gnarly, Dad. I said, guys, it's just hair. And they said, gnarly. And I said, well, thank you, because you've reassured me that in a long-term care crisis, you are absolutely useless to me. Because if you put suntan lotion on me, what chance do I have that you're going to bathe me or toilet me? There you have it. So what is long-term care? Very simple terms, it's an event. I mean, it can be the result of a chronic illness. It can be an acute illness. You can get T-boned in your car on the way home tonight from the office. It's usually unexpected, but it can progress from an illness or a condition. It's definitely something difficult for you and your family. Anybody not know that long-term care is expensive? Not long-term care insurance, but long-term care itself. It's expensive. But the greatest expense usually comes in the toll that it takes on the caregiver, on their physical health, on their emotional health. Their professional opportunities can be diminished. It's just a bad thing all the way around. So what is it specifically? Broadly defined, when you can't take care of yourself for any reason, whether it's cognitive because something's not working from the neck up, or because you simply need help with your activities of daily living. And you did all those daily activities of daily living today without even thinking about it. When you got out of bed this morning, that was transferring. And because the bed was dry, that means you don't have a problem with continence. The fact that you could go into the bathroom by yourself and toilet and bathe yourself, and then you dressed yourself, and then you went downstairs and fed yourself, those are the 6 activities of daily living. How many of you thought about those today? Probably not very many. But when you need help with 2 of 6 of those, or if you are cognitively impaired, and we'll talk about that in a minute, but typically it's for care that's going to extend at least 90 days as certified by your doctor. It's not the company's doctor or nurse. It's when your doctor says, yep, D needs at least 90 days of care, the plan kicks in. Oh, she got better after 60 days. My bad. That's okay. As long as when the certification was prepared, the belief was that it was going to be at least 90 days, the plan's going to cover you. As I said, cognitive impairment takes on the form of either an organic source or a non-organic source. And that sounds pretty nebulous. But when I look at a long-term care policy that says, and we cover extreme cognitive impairment or severe cognitive impairment, they're alluding to the organic sources that we're all familiar with: Alzheimer's, Parkinson's, dementia. When they emphasize that, what they're not saying is that we're going to cover the non-organic. And that could be a traumatic brain injury. It could be depression. It could be that you are so depressed that you're in the fetal position on the sofa. If you're in that kind of condition, you are non-organically cognitively impaired, and a good long-term care policy will kick in. Now, further disclaimer, I'm not talking about any carriers today. I'm not talking about any policies today. This is just going to be a very high-level view of what long-term care is and what it can do for you. So again, when you need help with 2 of these 6 conditions, or if you are cognitively impaired, your policy should kick in. So the people who work for me and what I do is we consider ourselves advocates. We are your advocate, which means I'm going to advocate for you with the carriers. When we submit your application, I'm going to write a letter to the underwriter helping you put your best foot forward so they see you as a 3-dimensional person, not a 1-dimensional paper file. If in fact they question something, I'm going to advocate on your behalf. If they say no, we're not going to offer you the coverage. Again, I'm going to advocate on your behalf. I have a pretty good track record because I know all the medical directors. Not that that's an advantage or a disadvantage, but I know what to say to them. And so we're gonna advocate on your behalf. If they rate you a certain way and we don't think that's an appropriate rating, we're gonna advocate on your behalf as well. My job is to understand the long-term care industry, basically because we're a brokerage. So if it's long-term care or long-term care related, we have a contract with those carriers. So when somebody says, well, I'd like to hear from other carriers or I'd like to get a couple more quotes, I can give you all the quotes you want. So that's an advantage of dealing with a long-term care specialist, is because we're going to have all the answers at our fingertips for you. We're going to do, rather than letting your fingers do the walking through the yellow pages, that's what we're going to do for you. And so hopefully save you a lot of time, and also more importantly, eliminate a lot of confusion, because there's a lot of misinformation out there as well. So the first thing I always want to clarify with folks is, why are we talking today? What's prompting your interest in long-term care? What do they want to get out of the meeting? And I would hope that whoever you meet with would bring that attitude to the table or to the screen. It varies. Depending on what your life experience is, that may be dictating a certain path or a certain course of action for you. When somebody says to me, well, my mom lived with us for 2 years, we took care of her as long as we could, it just got too hard, we ended up moving her to a facility, we spent $500,000 on her and she still ended up on Medicaid, we don't want that to happen to us. I get it. Or, I don't want to be a burden on my children like my mom was on us. That's okay. Everybody's got a different story and a different perspective. So one size does not fit all, and recognizing that, I want to know what is motivating you to look into this now. So it's a process, and the first thing we have to figure out is, do you qualify for long-term care? What do you mean, do I qualify? Well, just like you can't buy homeowners insurance when your house is on fire, or car insurance when it's wrapped around the car, around the telephone pole, while you pay for it with your money, you buy it with your health. So if you've waited too long, you might not qualify health-wise. So we're going to look at your health. We're going to look at your family history as well, and I'll explain that in a little bit too. But we're going to qualify you. Then we're going to see if you really need it. Somebody like Bill Gates doesn't need long-term care insurance. Though I have some very wealthy clients who bought long-term care insurance because as one retired orthopedic surgeon explained to me, if my wife had a stroke tomorrow, as a doctor, I know how to take care of her. But as her husband, I'd be a basket case. I like the fact that with one phone call, I've got somebody here who's going to coordinate the care and make sure she gets all the attention she needs. So we're going to educate you about long-term care. We'll design a plan for you that's tailored to fit you, and we start the process. So over the years, I've collected anecdotally from folks why they've bought long-term care insurance. This is probably the number one answer. So I'm not a burden on my children, because I know I can develop a condition at any time, because I'm healthy and I can qualify now. Long-term care is priced based on your age. So the older you are, the more you're going to pay. That makes sense. It's no different than any other life insurance. People want to choose where they receive care. During the pandemic, that was never more evident. Nobody wanted to go to a nursing home. A lot of people said that's a death sentence. Hopefully not. But if you can stay in your home, you're going to be more comfortable. And the carriers actually prefer that you stay in your home. Why? You're going to be more comfortable. You're going to presumably get better, more specialized care. It's cheaper for them. So it's a win-win. Donald, your microphone is on, so I'm going to ask you, do you expect Medicare to take care of you? Now you turned your microphone off. Now you're clever.
Sorry about that.
All right. You think
Actually,
Medicare's going to take care of
Medicare
you?
does not cover except very, very little long-term care, like 20 days.
Yep. And we'll talk. How about Medicaid? You looking forward to being on Medicaid?
Only if I want someone else in control of my long-term care
Absolutely.
and where I receive care.
And a facility. Yep. But protecting your funds, your legacy, and why do you think long-term care has tripled since 1983, the chances of needing it? Anybody come off of mute if you have a thought? Because I really don't want to do all the talking today.
Because we're getting older, we're living longer.
Yeah, we're living longer and we're dying slower. You know, advances in medicine, advances in pharmaceuticals, we're living longer. You know, when Teddy Roosevelt was president, the life expectancy was 47. When Franklin Roosevelt signed Social Security into law, and Social Security started at age 65, life expectancy was 63. It looked like a pretty safe bet. And there were 16 workers for every one person on Social Security. Now it's like 3 to 1. Average life expectancy is 83 or 81 right now. So we're living longer, we're dying slower. So it's really about quality of life. So when I sit down with a client, you know, the first thing I do is I explain the agenda. We're going to look at your personal health history. Why? We're going to take a snapshot of your health as it exists today. You know, if you tell me, well, I have a little bit of Parkinson's, there's no such thing as a little bit of Parkinson's or a little bit of Alzheimer's. It's like being a little pregnant. Either you are or you aren't. It used to be that we collected family history for anecdotal purposes. Now the carriers use that. So for example, if you have two parents that were both diagnosed with Alzheimer's or Parkinson's prior to the age of 60, you're going to have a harder time getting your coverage because we can't escape our DNA. We talk about what long-term care is. Idaho is a suitability state, which is a fancy way of saying that you and I, or the three of us, if you have a partner or a spouse, we have to jointly execute a statement for the state of Idaho that says, that this insurance policy is both appropriate and suitable for you. And what are you trying to protect, essentially? It's not a big deal. But I really like to make this a collaborative effort. And so we design your long-term care plan together. We review the cost of the plan, what it covers, how you can pay for it, and basically present you with all the information you need to make an informed decision. So why is personal health history so important? Because that's what they're going to, that's the criteria on which they're going to base the decision. Do we want to offer D Childers this coverage? What is our risk? What is our exposure? So your general health, any chronic conditions, prescription medications has become so much a part of the process. And I mentioned, writing a letter to the underwriter. I'm astounded, if we were sitting in a room, I would ask by a show of hands, how many of you take a prescription drug for something? And virtually every hand goes up. I almost put that on my bio sheet. I'm very proud of the fact that I don't take any prescription meds. Even when I go to my doctor's office for my physical and the nurse is reviewing, she goes, nothing? No, your prescriptions. I said, I don't take anything. Most people take something for something. What I'm astounded by is how many times they don't know why they're taking it. Oh, I've been taking that for years. What do you take it for? I don't know. That's tough. So if you fall into that category, the next time you go to your doctor, ask him or her, why am I taking this drug? Your physical activities. If you're still mowing the lawn and getting on ladders and you're going to the gym 5 days a week and you're still running marathons or you're still weeding the garden and doing all those types of things, those are important things for the underwriters to be aware of. It means you are active, you are vital, you're alive, you're healthy. It also gives me the ability to anticipate what your underwriting rating could be. You might be getting a preferred health discount. No one ever complains when I tell them that they're going to save 10 or 15% because of their health. So as I said, you pay for it with your money, but you buy it with your health. How many of you have heard of Susie Orman? Cough, raise your hand. Okay, great. About 20 years ago, Susie Orman was selling long-term care insurance for GE Financial on QVC. Anybody remember that? And she was advocating that a good time to buy this was age 55 or younger. Why do you think she said 55 or younger? Anybody?
Still in good health?
Yeah, you still have the good health that you need to qualify. Dave Ramsey, who a lot of people, listen to, and he's got some really good thoughts on how to avoid debt, get out of debt and such. Dave says 60. And unfortunately, by 60, a lot of times I can't help people. I mean, that sounds silly, but their health has deteriorated enough where I can't help them. So Susie says 55, it's in her books and such. Well, she wrote a mea culpa to the Chicago Tribune on my birthday a few years ago that said, I applied for my long-term care insurance at age 57, and I was declined for a condition that arose when I was 56. Had I followed my own advice, I would have coverage. Now, before you feel sorry for her, at that time, she was paying $25,000 a month for long-term care for her 97-year-old mother in South Florida. And she said, thank goodness I had the money. So she is self-insured, not by choice, but by necessity now. That's reality. So, I mentioned family history, the fact that we can't escape our DNA. So when I'm talking to men, I want to talk about grandfathers, fathers, uncles, older brothers. The women, the opposite. But I want to find out what your experience with long-term care has been. And what I have found is sometimes I have to connect the dots. Well, grandpa lived with us. Why? Well, when grandma died, someone needed to watch him because otherwise he'd go to the mailbox in his underwear. Okay, well, that's long-term care. What was that like for you? Well, at first it was kind of cool because I'd come home from school, I'd put down my books, I'd have a snack, I'd walk the dog, then I'd walk my grandfather. Okay. And what was that like? Well, we'd take walks around the block, and grandpa flew bombers in World War II. So he had some really neat stories and I really liked hearing them, but he got slower. The walks got longer. I knew all the stories. I could tell them better than he did. And by the time I graduated high school, I hated those walks. So how would you feel, Donald, if someday your grandchildren felt that way about you?
Not good, not good.
So, but we look at the family now because, again, it's a very good indication of what could happen to you. So if all the men start having strokes at age 65 and you're sitting at 61, still in relatively good health, yeah, you might beat the odds. But what if you're wrong? What makes you different than all the other men in your family? So that's why we look at the family history. People love numbers. So here are the obligatory numbers of long-term care. At any given time, if we went to a nursing home, 42% of the people there would be under the age of 65. They are there typically to rehab and get back into life. So they're kind of an aberration. There's a 90% probability that if you are part of a couple, I don't care if it's male, female, male, male, female, female, there's a 90% probability that one of you is going to go into a long-term care situation. Those are really lousy odds. And if you are a single woman, 65 or older, you got a 79% chance because 80% of all men who go into care are married. Think about that. 80% of all men who go into care are married. Who is their primary caregiver?
Spouse.
Their spouse. 80% of all women who go into care are single. Why is that?
Men
They're
die.
widowed.
He died. That's how he thanked her for the care. He died. And because men are older and typically live a shorter time than women, there's a lot of reasons for that occurring. And if those weren't enough statistics for you, we could go to the mall, sit in the food court, and 7 out of 10 people, regardless of their age, they're going to need long-term care at some point. The average is going to be 3 years, average being average, which means there are going to be claims for 12 months. There are going to be claims for 12 years. But the average claim is 3 years, unless it's Alzheimer's, in which case it's 8 to 10 years. So I mentioned that long-term care is expensive. And these are national numbers, and they don't really vary very much here in Boise and Idaho. So you're looking at, $48,000 or $4,000 a month if you want to stay in your home for 44 hours a week. And I've asked a lot of people over the years, where does 44 hours come in? If someone said 40 hours, I'd get it. That's 9 to 5. Is that a half a Saturday? Well, it's not a 9-hour day because that would be 45. So I don't know where that 44 comes in. I've never gotten a good answer for it in 20 years, but that's what it's based on. So, who's taking care of you the other 124 hours a week? And if you go to a nursing home, it's $100,000 a year. So we're looking at $300,000 potentially in your care. Oh, wait, but everybody here on this call isn't 83 years old yet. So what's it going to be 25 years from now? A couple $100,000 a year. Now we're talking 600,000. And for anybody who wants to, who's curious, at the bottom of the screen, I have that link to the Genworth Cost of Care Survey. You don't have to be an agent or a broker to access it. You can download it on the App Store if you're curious as to what the costs are in different parts of the country. But Genworth makes about 50,000 calls a year to get pricing in all the different communities across the country. And almost all the carriers, unless they have their own, and very few of them do, they rely on Genworth's Cost of Care Survey. So I'm going to pick on Dara if I can. So come off of mute.
All right, I'm game.
If you needed care tomorrow, where would you want to receive that care?
Ideally in my home.
Okay. And who is there who could provide that care? I mean, your husband works. Could he stay home and take care of you?
He could not.
I assume he'd have to keep working to put a roof over your head.
He would. And we might even have to move.
How about kids? You got those.
Yeah, and I really don't want to put that burden on them.
Well, okay. I mean, I was going to say, I mean, if they're school aged, I used to joke that we could keep them home every other day and they could take turns taking care of you. But after the pandemic with homeschooling, that's not a prospect anybody wants to entertain. For some reason, they want their kids in school.
Yeah.
So it sounds like we'd have to bring somebody in to care for you.
Yeah, I don't think I can convince my dogs to help.
Okay. So we have to bring somebody in to care for you. Where would the money come from to pay for your care?
Probably my retirement fund.
How do you feel about that?
Pretty sad.
That's not what you're earmarking that money for?
Well, it is not, especially if it means my husband won't have anything left when I'm gone.
Okay. So, and if you were staying at home and let's say it was $5,000 a month, how long could you afford to do that before it really started to hurt? And you don't have to answer that in truthfulness, but
Yeah, not very long.
So, I mean, and therein lies what we used to call the $64,000 question. Now we call it the $100,000 question, is how long could you afford to do this? So I should have asked, how many of you have a long-term care plan now? Anybody?
In reality, everyone has a long-term care plan. It just may not be intentional.
There you go.
Yeah, self-funded.
Yeah. The good graces of the Childers Insurance Company of Boise. Yeah.
All right.
Not exactly what we planned on. So anybody recognize this guy? Superman. And he was very proud of the fact that was all him in that costume. 6'4", 230 pounds, no padding, all him. And if you don't know his story, Chris Reeves got on a horse one morning, like he had hundreds of times before, age 42, got thrown from the horse, suffered some spinal and neck injuries, and for the next 10 years was in care. And despite the movie career, he actually attended Juilliard with Robin Williams. They were roommates. Robin Williams used to fundraise for his roommate's care. But for that, conceivably he could end up on Medicaid, which absolutely blows my mind, because you figure he had to make some serious money in those Superman movies. Michael J. Fox was 29 years old filming Back to the Future when he was diagnosed with, anybody know?
Parkinson's.
Parkinson's. My grandmother had Parkinson's. I know what it does. He kept it a secret for 12 years. He had the #1 show on television when he could no longer maintain that pace. And that's when he formally retired. No plan for long-term care. How many of these people do you recognize? Probably most of them. Anybody know why Neil Diamond's not touring anymore? Why he gave it up 2 years ago? Parkinson's. All the rest of these folks, I mean, except with Robin Williams, who had Lewy bodies, everybody else has Alzheimer's or Parkinson's. Sugar Ray. Somebody said, yeah, you know, you get punched in the head enough times, you're going to do some damage. That could be. Norman Rockwell, Jimmy Stewart, Peter Falk, Charlton Heston, Charles Bronson. Who's the dish on the left? Who recognizes her? Rita Hayworth, who was very big in the Alzheimer's Association before she got too sick to keep doing it. E.B. White wrote Charlotte's Web. Pat Summitt, a basketball coach. Rosa Parks, Estelle Getty, Burgess Meredith. This was kind of tragic because 2 years ago, I went to spring training in Arizona with the Cubs and went to Sloan Field, and I met Bill Buckner, who I had watched play for the Cubs when I lived in Chicago. And 2 months later, on Memorial Day, my daughter called me and said, hey, you know that baseball you got when you went to Arizona? I said, yeah. She goes, I think it went up in value. Bill Buckner died today, had a house in the foothills here in Boise. He had Lewy bodies disease. You would not, I saw him 2 months before that. He was fine. Patted me on the back, shook my hand, took a picture with me, signed a baseball. He looked great. My friend and I both thought, man, this guy's 69 years old. He looks awesome. 2 months later, he was dead. Failing to plan is planning to fail. So, you know, of paramount importance is no one ever plans on needing care, but is it something that could happen to you? And if it is, then I would encourage you to meet with somebody, you know, knowledgeable in long-term care planning that can help you come up with a plan that's tailored to fit your needs. If you don't think it's going to happen to you, then you can always fall back on self-insurance, play the odds. But if you know, if you went to Vegas and you knew you only had a 10% chance of winning, would you be willing to put your money down on the table? Probably not. That's really what you're talking about here, because there's a 90% probability that you or your partner's going into care. So where is care provided? And this is actually some of the, there's actually a silver lining to this otherwise dark cloud. So home health care, $3,000 to $5,000 a month. And that's where 69% of claimants begin their journey. That's the silver lining. If you need to go to an assisted living facility, that's where about 16% end up. It's only the unlucky 15% that end up in a skilled nursing facility. And that's not the 65-year-olds under 65-year-olds that we talked about previously. These are the people who are going to the skilled nursing facility and will not leave there vertically. They will live there until they pass. And that's only 15%. So, I mean, that's the silver lining. This is where I generally tell people or ask people, you know, without knowing premium or anything, Donald, how much money per month would you want the insurance company contributing to your care based on what you see on the screen?
Much as I could afford.
Okay.
$5,000 a month.
Okay. How about you, Dee? How much would you want the companies to contribute on your behalf? Pick a dollar amount.
6,000.
Okay. So that 6,000 to 8,000, by the way, is for a semi-private room. So if you want a private room, tack on about $2,000 a month. So a lot of times when I say that, people will say, well, I want $10,000 if I can afford it. And at that point I say, well, okay. And I'm happy to show it to you, but really, if we look at $6,000 a month, we've covered 85% of your risk in its entirety. And if you do end up in the skilled nursing facility, that $6,000 a month is going to put a pretty good dent in the cost. And ideally, your Social Security will make up the difference, and we won't impoverish your partner. Too much insurance is almost as bad as not enough. And they look at me and like, didn't you just talk yourself down out of a commission? Well, yeah. But if they're really there to take care of you, that's the way they should be thinking. You know, what's in your best interest? So what are the options that you have? We've talked about family. We've already established that Dara, her family's not going to work. How about you, Jamie? Could your family take care of you? Come off of mute if you want to participate. If not, that's okay. There are some government programs, which we'll talk about in a minute, which include Medicare, Medicaid, and partnership. Hello.
I was on mute, sorry.
No worries. So could your family take care of you?
I would certainly hope so.
Would you want them to?
Today, yes.
How about 10 years from now?
I wouldn't want them to have to.
Okay. So family, government, self-insurance, or you transfer some or all of the risk. So let's look at those options. Back in the day, you know, we had the Waltons, 3 generations under one roof. That was very common in our country. It was very common in a lot of other cultures. But even those folks have come, you know, with the boomer generation, have determined that doesn't work. You know, we're having fewer kids. They're scattered across the country. In fact, until we moved to Boise, we did not live within 2,000 miles of any of our kids. We were either in Chicago, Cincinnati, or Virginia, or Seattle, and they were out here in Utah and Idaho. So, you know, up until we made the trek west, we weren't near our kids. If we saw them, we went to them, or we sent them airline tickets to come to us. Women in the workforce, it just doesn't work. So for the most part, and even if they're willing, I mean, I've got several people who work for me right now who are living the nightmare. They're trying to figure out care for mom so that they can continue working. Actually, I've got 4 right now like that. Ironically enough, 2 of them have policies, 2 don't. And so as I was talking to each of them this week, I said, so how has life been with the policy? How's that worked for you? Oh my gosh, it makes life so easy. And for the ones that don't have it, you know, not rubbing salt in the wound, but now that they are in this industry, how would a policy have made life different for you and your family? Oh my gosh, it would have been incredible to have had this coverage for mom. So Donald gave us a little bit of a preview. Medicare, if you don't know it, is federal health insurance for people 65 and older, or the disabled, or for those suffering from the end stages of renal failure. It's a fancy way of saying your kidneys are dying and so are you. Does Medicare provide for long-term care? Anybody want to hazard a guess?
Unfortunately, no. Yeah.
Unfortunately, no. With a little asterisk, it will provide just a skosh. You know, most people think, well, the government's going to take care of me. The government is not going to take care of you. My biggest challenge being a military retiree is when I talk to veterans and they think, well, the VA is going to step in. We have the former chairman of the Joint Chiefs of Staff as a client. They didn't take care of him. He bought a policy. We have a number of three and 4 and 2-star generals living out in Patriots Landing near Seattle with private long-term care insurance. The VA is not the answer either. But Medicare will provide a limited basis of protection, essentially after a 3-day hospital stay for treatment. I have to actually change that and add that, because if you're there for observation, no sale. Has to be for treatment.
Must be admitted.
Pardon me?
Must be admitted.
Must be admitted, and you must be being treated, or that's the loophole. Medicare says, nope, no coverage. So 3 midnights for treatment, then you get moved to where? A
Rehab.
a facility of some kind. And so long as you are making progress and you don't plateau, they will give you up to 100 days of coverage. The first 20, full coverage. The next 80, you'll pay the daily copay. Anybody know what that is for ballpark?
$176 a day.
There you go. So multiply that by 80 plus the period or the benefit period surcharge. So you're not home free. But the average Medicare recipient receives how many days of coverage? Anybody want to hazard a guess?
100 and something.
I have
Right.
100 and something. Donald looks like he was stewing on this one. What do you think, sir? How many days?
On average,
Yeah.
probably less than 50.
How about 17? 17. That's the
Wow.
average. Yep. So yeah, Medicare, not the ideal.
Yeah, so they're going to try to get out of it.
Yep. So then there's Medicaid. Now, Medicaid provides about 60% of the care in this country. Only one prerequisite. What is it?
Give me all your money.
That's it. You just got to be broke, indigent, however you want to phrase it. Now, if you're married or in a relationship, do you really want to impoverish the spouse? And there are exceptions and there are limitations. You know, they get to keep the house. Oh, but Congress has told the states, you put a lien on that house. So when that healthy spouse checks out, we get our money back from that house equity. They keep a car. Most states don't put a premium on the car. So that's why you see some really expensive cars in the parking lots of the nursing homes. But in most states, you do have to spend down your assets to $2,000. But what people forget is that there's another qualification for Medicaid. It's not just what you own and what assets you have. It's what income do you have? And I had somebody call me about a month ago and said, my dad makes $13 more than he's allowed to, and he doesn't qualify for Medicaid. What are his options? That was tricky. And fortunately, he was a veteran with wartime service, and we were able to get him some aid and attendance. But, you know, usually the options are pretty slim. But
So
then,
can I just sell my assets so then I qualify or give them away?
what do you think? Could you sell them or give them away, or will them to the kids, or favorite charity or alumni association?
Can you put stuff in a trust in your kids' names?
No, and no.
Okay.
The government will look back. Used to be 3 years. Now they're looking back 5 years for any activity where you may have transferred assets. Because believe it or not, people commit fraud when they are contemplating Medicaid. So pretty gloomy picture here so far, but there is good news in terms of the government. So somebody asked me the other day, because if you're aware, some of you are probably aware that Washington State just passed this law where they're going to tax people involuntarily unless they opt out by buying a long-term care policy. You know, does the state mind that you're selling policies to their citizens? No, because in the picture perfect world, the state would love to see everybody with a private long-term care policy because it would completely alleviate the need for the Medicaid system to embrace and support the long-term care for these folks. So Medicaid is federally funded and state administered, federally and state funded, but state administered. Back in 1996, the feds passed HIPAA. Part of HIPAA was, you know, tax qualifying these plans, which means if they're paying for it, you know, the premiums are deductible or a credit, depending again on the state that we're in. Depending how old you are determines how much of the premium you can take off. Every year, my accountant says, did you pay your long-term care premiums? Yep. And then he just determines, is it better fit on my Schedule A or on my Schedule C? But I get the maximum benefit of owning that policy. A few years later, you know, OBRA and the Deficit Reduction Act, the feds took $1 billion out of the Medicaid budget. But at the same time said to all 50 state governors, you can offer partnership to your citizens. Well, how does partnership work? So let's say you have a $500,000 estate and you're self-insuring. In order to access Medicaid, how much of that $500,000 do you have to spend down? Usually all but $2,000 of it. But then you're eligible for Medicaid. You just leave the family with no legacy though. So partnership scenario, modest $300,000 plan, same $500,000 estate. I have this propensity to want to spend the insurance company's money first. So I like short, fat plans because we can always stretch it out. And I'll show you what I mean by that in a little bit, as opposed to long and lean. So we run through that $300,000 and now you're spending down your money, but you only have to spend it down to the level of the coverage that you had. So you spend $200,000 down, the family estate is now worth $300,000. You're on Medicaid and the family still has that money. So for most folks here in Idaho, partnership is a good thing. In California, where, you know, houses are 7 figures typically, and you have to spend the equity down to $829,000 or some ridiculous number, it's not as attractive. But for most folks who have, you know, $250,000 to $1 million of assets, partnership is a really, really good thing. You know how much more it costs to own a partnership insurance policy as opposed to just a plain old policy? It doesn't cost anything more. You just have to make sure that it complies with the requirements, which includes some kind of inflation rider on there, so the policy is growing along with the inflation rate. I mentioned suitability earlier. So we look at your income, your assets, your need for coverage, your personal goals, and we determine it. It's very rare that I get somebody that I can't help because of suitability. I mean, Billy Bland lived in a trailer park, drove a school bus. He was 72 years old. One person in my office said, why are you gonna go see him? He lives in a trailer park. The man had $1 million in the bank. He liked where he lived. He liked the kids. He'd been driving a bus for 20 years. Perfectly suitable. So that's why you never judge a book by its cover. So what do you protect? This is actually kind of fun for me. So typically these are all the different things that make up the Ray nest egg. And because most people want to have care in their home, I will draw a fence around the home, and we don't even include the home in your assets. You got to have a home. A box underneath the train trestle doesn't work. So how many of you own your own home? I wish everybody had their camera on. It makes it so much easier. Okay, so there we go. Look at that. Everybody still have, anybody own their home outright and drop the homeowners income, homeowners insurance?
No?
No? Does that sound like a stupid question? Be honest.
Yes.
I was sitting in Northbrook, Illinois, 3 doors down from Jim McMahon's house when he was quarterbacking for the Bears. 1999. Houses in there were all worth at least $1 million. And I said, and you have homeowners insurance? And the man said to me, oh, no. I paid the house off about 6 months ago and I dropped the insurance. I put my pen down. I mean, I was new enough at this. I was stunned. And I said, you're going to have to explain that to me. And his wife looked at him and said, we don't have homeowners? And he goes, I'm saving us $2,500 a year. And so when I got my jaw off the table, I said, and he goes, well, Don, land doesn't burn. I went, okay. And he goes, brick house. Okay, how about the walls, the furniture, the appliances? He goes, well, yeah. He says, I figure that's about 200 grand. His wife says, we don't have homeowners. And she looked at me and said, he's an idiot. We'll have homeowners by 5 o'clock. So yes, we have homeowners. Okay. How many of you have either personally or known somebody to lose their home because of fire, earthquake, flood, whatever?
Yes.
Okay. How many, D? How many homes? Bless you.
Thank you. I know 2 friends that have had their house burned down while they were at work.
Okay, so that's 2. How many for you, Dara? 3. That's the most I've had probably in the last 4 years. I'm up to 3 as well. Anybody else? Most people it's 0 or 1. So that's because the odds or the risk to the insurance company of your home disappearing is about 1 in 1,200. It's pretty remote. Does
I just
anybody?
know a lot of people.
You do. So, how many of you lay awake at night thinking about what your homeowner's insurance costs you? Good. So, does everybody drive a car? Are you fully insured, modestly insured, state minimums? Where do you fit on that spectrum?
Fully.
Fully. Do you pay more for your car insurance or for your homeowners?
I have teenage drivers, so I pay more.
There you go. Most people do. Why is that? You gave one of the reasons.
Teenagers and likely.
More car
likely-
wrecks.
Yeah.
than there are house fires.
The chances of you totaling a car, how many of you have totaled a car in your family? My son has gone through 4 cars. And when he turned 21 and got married and he couldn't find anybody who would issue him car insurance, he was really upset by that. Go figure. So why do you pay more for your car insurance than your homeowners? What do you think? Because the risk to the insurance company is 5 times as great. The odds are about 1 in 240. Everybody have health insurance? What do you pay more for, your health insurance or your car insurance?
Oh, health.
Health insurance by a factor of many.
Yeah, why do you think that is, Dara?
Because I think I go to the doctor even more than I wreck my car.
Exactly. So without sounding like a Billy Crystal routine, by the time you're 65, the odds of you needing a procedure, like my wife had 7 years ago when we lived in Seattle, She had a hip replacement at age 62. She was in the hospital 26 hours, start to finish. $95,000. 1 in 15. So 1 in 1,200, 1 in 240, 1 in 15. Who owns life insurance here? Permanent or term or both? Term? Anybody have permanent?
I have both, yeah.
You have both? What do you pay more for, permanent or your term? Not a trick question.
Well, they're not worth the same. My
Right.
permanent, on a per dollar basis, my permanent.
So what is the risk to the insurance company on that permanent policy? What is the risk that they're gonna have to pay out?
100%.
100%. As long as you're current in your premiums, they have to pay out 100%. How about on term? Anybody know what the average number of term policies that go to claim?
Yeah, less than 2%.
On the money, 2%. That's where they make their money.
Really?
Yeah. That's why they can almost give it away, because they know they're not going to pay on it.
It gets too expensive when you get to be 60.
That's it. So, if you have lifetime income, pensions of any kind, in this day and age, that's really rare and becoming even more rare with each passing year. I mean, we've gone from pensions to, defined benefit plans to defined contribution plans. But I mean, for the most part, we're on our own when it comes to retirement. And so, we've built these walls between these risks and our nest egg, protecting the nest egg, except for this thing on the dotted line on the bottom. And that's long-term care. And what's protecting your nest egg against long-term care? Your health. And how quickly can your health change? I mentioned the T-bone car accident or the diagnosis at the doctor's office. Are you a diagnosis away from no longer qualifying for the long-term care policy that you might want? So can you think of anything other than the risk of long-term care that could involuntarily wipe out your life savings, take away your independence, and make you a ward of the state or your children? That's a thought that terrifies me. The most common answer I get to this question is, well, the stock market could tank. Yes, it could, but you are in the market voluntarily. So there really is nothing else. I mean, it is the single greatest risk that we face. And yet, for some reason, it's the risk that most people fail to insure against. So there are 3 ways to pay for long-term care. Be very rich, be very poor, or be insured. It takes you a lifetime to build your nest egg. Why lose it? So a lot of people, now that they're buying it in their 40s and 50s, as opposed to 68, which was the average age when I started in the business, they say, okay, I know I'm going to use discretionary income while I'm working, but how do I pay for it after I'm done working? Or, what other ways can I generate income to pay for my long-term care insurance policy? So, when we were looking at that nest egg, we ascertained that they had qualified funds and non-qualified funds. So let's say you have $250,000. So who wants to play along with me?
Hey, I'll do it.
Okay. So Donald, you got $250,000 in your qualified funds. What's a conservative rate of return you're getting on that?
Conservative, we'll say 6%.
6%. Okay, I hear you're 6. I'm going to knock it down to 4 because I want to be really conservative. And are you touching any of that money, or is it just continuing to roll over?
It's deferred.
Okay, so it's rolling over. Now, I've talked to people over the years and they say, well, we use it to pay our real estate taxes. Or this one couple I met, they took 4 trips a year to Ireland, where they were born. And so the compromise we reached is they were going to make 3 trips a year and use the 4th trip's money to pay for their long-term care, unless they could scrape up the money from their discretionary funds to pay for a 4th trip. That works. So right now you're self-insured. We've told you that if you have a long-term care crisis, it's 3 years and $100,000 a year. So how much of that 250 in all likelihood is going to be left over?
Zilch.
Zilch is correct. What we're talking about, is your plans for retirement, and you shared with me earlier, golden retirement, maybe 529 accounts for the grandkids. You want to travel, you want to build the boat like Gibbs did in the basement on NCIS, whatever floats your boat. I don't care. It's your plan. You want to build a cabin on Orcas Island. So what we're talking about is transferring some of the risk or all of the risk from your insurance company to a commercial insurance company, so that if we have that same long-term care crisis and the company is paying your costs, how much of that 250,000 could potentially be left intact? All of it. So, if we go down the left channel, odds are you're not going to hit your plans for retirement. Whereas if you, pass some of the risk over, the answer is yes. So then the question becomes, how much of that 10,000 would you be willing to invest in a policy that also safeguards the balance of your estate? And again, it's different for everybody. But that's a concept that I share with folks, that they could painlessly pay for their long-term care insurance. So how does long-term care work? And we're streaking for the finish line. It can be flexible. And I know people read about all the gloom and doom in the newspapers and how the long-term care insurance industry is in a death spiral. Well, no, it's morphed. It's definitely changed. What used to be just a traditional standalone long-term care policy industry, now you have asset-based products, and you can put annuities in place with a long-term care rider. You can buy life insurance with a long-term care rider. So the industry is still there. It's just changed. So we're flexible. We can design plans focused completely on price or completely on benefits, or more likely somewhere in between. And this is where it gets really collaborative. But before we design a plan for you, you need to understand the terminology. So you'll hear benefit amount, you'll hear monthly maximum, you'll hear daily maximum. I like a monthly maximum, because if your care is erratic during the week. So for example, when I started in the business, weekly maximums were brand new. And everybody thought those were incredibly sexy, because if on Monday, Wednesday, if you had $100 a day benefit, for example, and on Monday, Wednesday, and Friday, you only had, your 9 to 5 caregiver in there, and there was only $80 or $90 a day, you were covered. Tuesdays and Thursdays, oh yeah, the OT and the PT person comes in, and that's $200 a day. So now you're out of pocket $100 each of those days. With a weekly maximum, you were able to look at the total expenses for the week, and as long as it didn't exceed that weekly total, you were good to go. Well, when everybody started getting weeklies, one of the carriers came out with a monthly maximum, and that's pretty much where we are today, is the monthly maximum. So when we say benefit amount, it's what can you get from the carrier on a monthly basis? Then the question is, how long do you want this plan to be? 2 years, 3 years, 4 years, 5 years, lifetime, which is unlimited. So we look at your monthly maximum times your multiplier, and that gives us a pool of benefits. Now that's a very nebulous term. So I want you to think of it as a checkbook, better yet, a money market account against which you can write checks. The only limitation is you can't write a check bigger than your monthly maximum. So if you have a pool of, well, we'll get to that. So hold that thought. So then you have the elimination period. You can think of that as your deductible. They range from 0 days to 365 days. I always recommend 90 days with a 0 day in the home so that you begin care in the home. As long as you stay at least 90 days in your home, when you do go to a facility, you go there with no elimination period. That being said, when I show folks what a 0 day costs, they're shocked because it's tremendously more expensive. And if I show them how little they save, like one carrier going from 90 days to 180 days, average plan, I might save them $25 a year. And doubling it to 365 days, so the first year you're without coverage, I save them another $5. It's crazy. 90 day is the optimal EP. We mentioned inflation earlier. If you want this to be a partnership plan, there has to be inflation protection on there. You're only 45. Average claim age is 83 now. That's 38 years down the road. You need the plan to be growing along with the cost of care. And then there are other optional benefits, especially for couples in terms of survivorship or shared plans, and we'll illustrate that for you in a minute. So couples do very well when they buy a plan together. You know, we could form 2 individual plans, $5,000 a month, 36 months. They each have a pool of $180,000. So Dara's husband, and I can't remember his name, Dara. What's your husband's name?
Jonathan.
Jonathan gets sick and he wipes through his $180,000 and he bats his baby blues at Dara and says, "Baby, can I have some of your coverage?" And of course she says, "Of course." The company says, "Not a chance. Those are 2 separate contracts. What are you thinking?" So for couples, I like to form one large plan, still $5,000 a month. Now it's 72 months. Yes, they could each be on claim simultaneously for $5,000 and they'd still only get 36 months out of it. It's the exact same coverage. The difference is either one of them can have access to the pool of benefits. What does that look like to you? Think outside the box.
Mickey Mouse.
Mickey Mouse. You win. But there's absolutely nothing Mickey Mouse about this. But couples are always awarded couples discounts. So that's a good way to save money. Most carriers will have a waiver of premium. So if you are on claim, your premium is waived. If you buy a joint plan, you can do a joint waiver of premium. So then there's no premium due for either one of you. So those are just some of the options that couples have. This is a point that for some reason just eludes people. So I always come back to it. So if you have that $5,000 a month benefit for 36 months, we're creating a benefit pool of $180,000. And what's the single largest check you can write any given month? $1,000. Now, keep in mind, if you buy the inflation next year, that with 3%, you know, that 5,000 will have grown to 5,150. The 180,000's up to, you know, 185,400. But what if you're only spending 2,500 a month?
It's going to last longer.
It's going to last longer. So again, short and fat, because we can stretch it out, but we can't reel it in and borrow from the future. So the rule of thumb is so long as you have checks and as long as there's money in the account, you can write a check. Years ago, I was a commander in Germany and American Express called me and said, "Captain, you have a young man who's bouncing checks all over Germany." I called him in my office. I said, Hanson, what are you doing? He says, sir, how can I be out of money? I still have checks left. True story. Doesn't apply here. There's got to be money left in the account for you to write checks. Again, we know the cost of care goes up. Over the last 25 years, it's averaged about 3%. So if you put a 3% rider on your contract, you're not going to lose ground or lose much ground to the cost of care. So it keeps up with the costs. The policies, how many of you have heard something really derogatory about the long-term care industry and rate, big rate increases or, yeah, ugly. I was actually on a call with a carrier yesterday. They invited me on to talk about that very issue because I was giving them voice of customer from the field. What a train wreck. What a train wreck of a conversation. They were so out of touch. The policies being sold today are priced much more effectively. The policies that you're hearing about these huge increases on were written back in the 80s, the 90s, and the very early 2000s. The assumptions they were based on were somewhat faulty. Now, with millions of policy years of data, the policies are pretty level, and you don't hear about big increases or, a couple of the carriers we represent, their policies have stayed stable for the last 7 years. So the policies being sold today are much more stable, and any anticipated increases would be single digits, which look at how gasoline, milk, the cost of your car, the cost of your house, well, maybe not the house now, especially in Boise, holy cow, what a crazy market. But it's all about leveraging your dollars. So as I said, you can buy a traditional standalone policy. You can look at a life insurance policy with a long-term care rider. So if you're talking to younger people who are experiencing those life events, marriage, babies, who have that life insurance need, maybe the long-term care rider is a good fit. An annuity with a long-term care rider works for people who have lazy money or just want to reallocate their funds. Same thing with the hybrid. So if they die, there's a death benefit. If they live and go into a care situation, they use those benefits. And if they change their mind down the road, they quit, they get their money back. So for those products, we call them live, die, and quit products. So there really is something for everybody now. Whereas 20 years ago, this was nursing home coverage. I was at the very beginning of where it was home health care. We can stay in our home. Oh yeah. Oh yeah. So again, it's tailored. One size does not fit all. And my job is to help you fit that plan to what your needs and desires are. Rosalind Carter said there are 4 kinds of people in this world: those who have been caregivers, those who are currently caregivers, those who will be caregivers, and those who will need caregivers. Pretty much sums it up. I've been a caregiver to 5 different family members. First time I was 13 years old. My grandfather had stomach cancer and colon cancer. He had a colostomy. I'll let you conclude what kind of caregiving was involved there. So, questions, comments, great thoughts.
Wow, great content.
Comprehensive.
And I'm really,
well,
I just want to say, Dawn, how pleased I am that not only to have attended this training myself so that I can be more informed, but I did receive several emails today from people who are planning to attend and weren't able, and they wanted to make sure we were recording. So we did record, and we'll get that posted, and it'll be available in our video library. So I am, this is an important one for people to be able to see. And honestly, I think there are parts I might go back and listen to again before I call you.
Okay. that would be fine. So, you know, again,
Any
Yeah.
other questions out there from any?
Dawn, it was an excellent presentation. Thank you. There's so many people that misunderstand the options and the flexibility and the value that this kind of plan brings. And it's unfortunate how many people haven't done the planning for our senior years.
it's tragic. And, you know, I go to church on Sunday, and last year I was sitting in a leadership meeting. They said, oh, poor so-and-so, she had a mini stroke. My ears perk up. What caused the mini stroke? Well, she basically was taking care of her mother-in-law at night, and after 6 weeks of not sleeping, she had a mini stroke. And when the symptoms abated, she drove herself to the doctor. I mean, that's tragic.
Yeah.
Or if we can just get so-and-so into the hospital for 5 days, then Medicare will pick up and pay for her long-term care. Time out on the field. Let's talk about that.
Lots of misunderstandings.
Yeah. So that's why I say it's all about education and awareness and giving people the information they need to make an informed decision. So, but that's what Learn's all about. That's what we're here for.
Exactly. Thank you, Dawn. Thank
You
you very
bet.
much for presenting. And our technological expert, Dara Ray, will have this up on the website sometime in the next week or so. So anybody that missed it, or you can refer this out to friends and family who need to see it and weren't able to attend today. So again, thank you so very much for being our presenter today.